Alexandra, good to see you this morning. Obviously, Christine Lagarde wants to put the most positive spin on the central bank action so far. But as I look at your forecasts running into next year, you do anticipate some deterioration in asset quality, particularly in the high yield market. Tell us a little bit more about how you think the next 12 months plays out.
Yes, good morning, Jeff. And indeed, to start with, this extraordinary monetary stimulus has been effective in averting a liquidity crisis, as Mrs. Lagarde was saying, and definitely cushioned the blow from the COVID-led shock. Now, while this is helping enormously from a liquidity standpoint, this is not resolving solvency issues. And I think here what's going to be critical in the next 6 to 12 months is going to be how we see the economy recovering, private demand coming back to sufficient levels then to enable the gradual withdrawal from the fiscal support. And here maybe also just to bounce back on the remarks from the IMF, we agree that fiscal policy is going to be really critical in shaping the recovery in the next 6 to 12 months. So essentially, we need to bridge a gap and preserve the economic and social fabric until that private demand comes back. And really, there are several critical factors here. One is obviously, first and foremost, will be the resolution of the pandemic. And that will come once a vaccine is broadly available across geography and in sufficient quantity. So our assumptions for that in the middle of next year. Now, the accommodative monetary policy will help because we will continue to provide cheap access to liquidity. But in parallel, indeed, the fiscal policy will have a role to play on helping companies in that period. Now, our key message here, Jeff, is that in the next 6 to 12 months, we actually see increasing widening gaps. We entitled our last report the K-shaped recovery between those industries that are faring quite well. Actually, there are even some winners from the current situation, the shift in habits with the working from home and the online retail. So some industries are going through that period fairly well or winning. But on the other hand, you have all of these sectors that are more vulnerable to the social distancing measure, the halt on international travel, the collapse in global demand. So all transportations, airline, automotive, media entertainment, retail. Here we see a lot more credit hit to
Alexandra,
come on these sectors.
Let me just jump in for a moment because I'm intrigued. I mean, you talked about the junk default rate potentially doubling by June of 2021 to 12.5% for the United States here, a rise as well for Europe. How does that compare with previous financial crises or recessions that we've seen? Is that number anything to be alarmed about? Does it raise the spectre of some kind of cascading credit event in the high yield space?
Yeah, so one point though in terms of how we define default, Jeff, is that it includes bankruptcies, but it also includes the missed interest on capital payment, which has been the main source of default so far, and the debt restructuring for which investors are losing. So it's a broader definition than just bankruptcies. It would compare pretty much like the great financial crisis, but I think there's one major difference here, which is that what we might see is default increasing maybe more slowly as a result of this unprecedented monetary and fiscal support, but potentially stay higher for a longer period, because we think this support is going to cushion the blow, but ultimately at this stage, we have 40% of speculative grade corporate rated B- and below, and 16% are in the CCC category. And these are ratings level that really indicate a strong vulnerability to changes in business and financial cycle, which shows in some cases unsustainable capital structure. So at some point, some of these companies which business model might be obsolete, unsustainable capital structure, then indeed might default, which is why we expect default rates to continue to increase in the next 6 to 12 months.